Dear colleagues, I would like to present my report concerning the impact of COVID-19 on trends in funded pension funds. In many countries in which the achievement of a balanced pension system is achieved through a sustainable pension policy, an important place is devoted to funded pension schemes. The development of the latter is related to the business dynamics, labor and financial market trends, which since the beginning of 2020 have been strongly affected by the COVID-19 pandemic, led to low interest rates, an increase in unemployment, contraction of production, the financial markets volatility with the outline of a clear negative returns tendency. It's obvious that COVID-19 crisis adds pressure to private and public pension systems. In this regard, it was examined commonly accepted statistical indicators for the economic, social, and financial significance of the funded pension program during the years of the so-called pandemic COVID-19. This analysis can be an important argument in support of the development of the pension market for the insurance model and the economy of a particular country. The main indicators. The first one, volume of private pension funds. The change in the volume of private pension assets in the Organization for Economic Development and Cooperation, OECD, countries for the period 2019-2020 outlines an increase of 11%, with an absolute amount of more than 56 trillion US dollars. The statistics indicate that the nominal growth of pension assets for a total of 77 countries for which the OECD provides data is positive both for the period 2010-2020 and for the period 2019-2020, although it's lower for the second period. The factors for the increase can be found in the sphere of policy and regulation. The ratio of private pension assets to the size of a country's economy, measured by gross domestic product (GDP), called the penetration rate, indicates the importance of pension funds for the economic development and serves to assess the recovery of pension assets after crisis periods. A large range of variation is observed in 7 countries: the Netherlands, Iceland, Switzerland, the United Kingdom, Denmark, Sweden, and the USA. Pension assets exceed GDP. Ergo, the penetration rate is above 100%. In C countries developing funded insurance over the last 20-25 years, the proportion of pension assets to GDP is below 20%, which means that it can expect a faster increase ratio depending on the implemented policy and the degree of mandatory participation. The role of funded pension plans, especially those based on defined contribution, DC, has grown significantly in recent decades. This trend does not change in 2019-2020. Financial and economic crisis explained the retreat from defined benefit pensions, with the problems that arise with the difficulties in maintaining the solvency and overcoming the deficit. The faster development of DC pensions stands out due to the closure of occupational defined benefit schemes by their sponsors to new entrants and stimulating workers to join plans in defined contribution schemes. What about population coverage? In 1/3 of the OECD members countries, mandatory or quasi-mandatory pension system is a prerequisite both for high population coverage as a whole and for achieving a replacement rate of around and above 60%. The population coverage is highest in countries with mandatory participation in private pension plans. For example, Australia, Chile, Estonia, Iceland, Israel, Sweden, and Switzerland. Population coverage is around and above 70% of working age population, and in Bulgaria this percentage is equal to 100. The low coverage of the population in individual countries with mandatory participation can be explained by the high relative share of the informal labor market. The outlined dynamics of funded pension schemes and the achievement of development goals also reflect the pension fund performance measured by asset nominal and real return. In the decade following the financial markets recovery after the crisis of 2008, the variation of the pension fund's returns is clearly expressed, but in the majority of countries, the annual nominal and the real return are positive, and for 2019, these values are more high compared to their level at the end of 2020. In 2020, only Japan, Poland, and Australia have negative returns. I have to say that saving for retirement is a process covering an average of 35-40 years, and this requires the pension fund return be considered over the entire period of accumulation, not just during the unfavorable periods of its level. The total replacement rate indicates all sources of pension, and therefore funded pension schemes are the determinant in its structure. In the majority of countries where these pension programs are implemented, the pay-as-you-go pillar also functions. This gives funded schemes a complementary role in terms of replacement rate. Data for the relative contribution of funded pension schemes in some OECD countries show that the lower the level of the pay-as-you-go system replacement rate, the larger the relative share in the total coefficient of pensions from private pension plans. If the person receives only a pension from pay-as-you-go system, then his replacement ratio will be significantly lower compared to using diversified sources of pension income. This particularly affects high-income population group. The development of privately managed pension funds in Bulgaria should be analysis by the change in the number of participants, the dynamics of asset and their proportion to GDP, and the performance indicators of the investment portfolios. Permanent increase in the number of participants in the additional pension funds is a tendency from 2002 till the end of 2020. Pension assets in Bulgaria outline a growth of nearly 11% in 2020 compared to previous year, and in 2021 they continued their positive change, being nearly 13% more compared to their level in 2020. Due to the negative will in the past year, 2020, the assets are over 1.7 lower their level at the end of 2021. Penetration ratio changed from 13% in 2019 to 14.8 at the end of 2020 and remains almost at the same level in 2021. This indicator for Bulgaria in previous 2 years, especially in real terms, has limited opportunities for growth given the downward development of the financial market in the last year and the state of business after COVID-19 crisis. According to this indicator, the pension market in Bulgaria is in the group of so-called countries with developing markets. Bulgaria is among the countries with the weakest development of voluntary pension insurance, and the participation in them did not increase during the mentioned period. For 2020, the nominal rate of return is 2.5% and the real rate is 2.3%. The return on funded pensions funds outlined a positive return until 2021, when the average arithmetic profitability was over 4%, 5%, over 6% for respectively universal, occupational, and voluntary funds. Published yield data for the last year, however, shows a negative yield, and it's rather high negative. As in a number of other European countries, the pension system in Bulgaria must adapt to unfavorable demographic changes. There is some potential for mitigating the impact of them on the pension system through parametric changes, some of which relate to ensuring a decent standard of living for the elderly by increasing compulsory social security contributions and stimulating supplementary voluntary pension insurance. The outlined trends disclose that in the COVID-19 pandemic conditions, the profound processes of population aging and reduction of the income replacement ratio of the public part of the pension system have activated the policy in the OECD countries as a whole regarding the stabilization and stimulation of participation in funded pension programs, as a result of which these programs continue to develop dynamically and upwardly. This global trend shows the important role that funded pension plans have or will have in the aggregate replacement rate. But for the developing pension insurance market, including Bulgaria, this role will be evaluated with an increase in pension fund maturity. Reality is that private pension funds have struggled with different crises, COVID-19, financial market downturn, etc., over the past years, and most are facing manageable challenges and risks. Thank you for your attention.